Why are sugar storage and transportation costs so high? Imagine trying to keep a bag of sugar fresh and pure from the moment it leaves the farm to when it reaches your kitchen. It sounds simple, but the costs behind that process are surprisingly high. Sugar is a bulk agricultural commodity, which means it is produced in large quantities and needs special handling. To keep it from spoiling or getting contaminated, it must be stored in large silos or warehouses that control humidity and temperature. These facilities are expensive to build and maintain because sugar is sensitive to moisture and pests. During peak harvest times or export seasons, storage space can become limited, pushing prices even higher. Transporting sugar is no small feat either. It is shipped in massive quantities using large ships called bulk carriers. These ships are designed to carry thousands of tons of sugar at once, but shipping costs have gone up a lot recently. Rising fuel prices, global supply chain issues, and limited shipping capacity have all played a role. For example, freight rates for dry bulk ships have hit multi-year highs, making each shipment more costly. Moving sugar from countries like Brazil to major markets such as China or the United States can cost tens of thousands of dollars just in freight alone. The journey from farm to market involves multiple steps. First, trucks or trains carry sugar from farms to ports. Then it is loaded onto ships for international shipping. After arriving at the destination port, it must be unloaded, stored again if needed, and transported to final buyers. Each of these stages adds to the overall cost. When delays happen, whether due to port congestion or weather, costs rise even more. Domestic freight costs are also climbing because truck and rail rates are higher, which adds to the total expense of moving sugar around. Trade policies and tariffs also influence costs. Many countries limit how much sugar they can import duty-free through quotas. Anything imported beyond these limits faces high tariffs, which increase the final price. These tariffs, combined with transportation expenses, make sugar more expensive for consumers and traders. Traders often have to hold larger inventories to manage these costs, which means higher storage expenses. For investors in commodities, these high costs mean that sugar prices can be quite volatile. When transportation or storage costs rise, it can squeeze profit margins for producers and traders. But it can also create opportunities for those who understand how shipping costs influence regional supply and demand. If shipping costs drop or storage becomes cheaper, prices might fall, and vice versa. In short, sugar storage and transportation costs stay high because it needs special storage to stay fresh. Shipping rates are elevated due to global logistics issues, and trade policies add extra expenses. These factors all work together to influence how much sugar costs from the farm to your table and how investors view its market potential.